Good morning, everyone. Welcome. I'm Jim Simpson, the CEO of East Daily. My purview for 2024 is to learn crude oil markets with my Director of Crude Oil Analytics, Christy Olsak, who is in the room with me as well. And then also joining us is Nigel Gorbold, my Vice President of Consulting. So welcome. We're happy to have you guys this morning. We're ready to dive into our Q1 2024 crude market update and 3 reasons to not be bearish in 2024. First, Nige, what do our clients say about us?
So I think what our customers like about us, Jim, is, I like to say we're big data, right? We take data and we make sense of the data and we clean it up and we package it in a way that people don't either have the resources or the time to do. We leverage that data to help people either make better decisions or faster decisions. And that's through either data delivery. So we have dashboards, we have data delivery, we have data provision through our Energy Data Studio, but we also have our consulting business where we can actually build up custom deliverables, and we'll talk about that a little bit at the end, and actually leverage that data to get to an actual specific answer.
Awesome. Let's dive in. So 3 reasons to not be bearish in 2024. I was careful to not, I don't know at East Daily, from my standpoint, looking at crude markets, I'm not bearish and I'm not bullish really. So I'm just kind of somewhere in the middle between $70 and $80. 1, Permian to Corpus filled in 2023. Permian to Houston is going to fill in 2024. 2, TMX coming online is going to structurally change flows and price spreads in the US. And 3, demand's the price mover. OPEC Plus and China are driving with SPR backseat driving. So let's dive in. Permian to Corpus filled in 23. Permian to Houston fills in 24. So I'd like to level set with just what happened in 2023 in regards to crude oil production. So we did see growth in the Bakken, about 140,000 barrels a day. So Bakken did grow. And of course, Permian grew 510,000 barrels a day, grew a lot. So when we kind of move forward to 2024 crude growth, we still see Bakken growing. Of course, we still see Permian growing a lot, 630,000 barrels a day. So it's where those barrels are going to go that we're really, paying attention to. So when we look, this is our crude egress. We get a lot of questions, our natural gas egress out of the Permian. And we get a lot of questions about, is there room to is there room to increase barrels? Well, when we look right there at kind of end of 23 going into 2024, the dotted red line is actual total nameplate capacity. And then the black line's effective capacity, the bulk of that difference being Mexico. We have plenty of capacity to Mexico. We just don't have demand on the other end. So in the increase that, of course, allowed crude oil to grow 2023 and into 24, we had the Whistler expansion, and then Matterhorn is the big one, and that gives quite a bit of gas egress, relieves the gas egress constraint. So the other questions we get a lot on the Permian is impact of M&A. So the bar at the bottom, this bar chart at the bottom, are acquirers, and at the top are those that have been acquired. And acquiring upstream operators laid down many of the rigs on acquired assets while keeping their rig counts, for the most part, steady. The primary motivation of the larger companies on the acquiring companies is to get inventory while remaining in a positive cash flow. And then acquired private operators dropped rigs by nearly 70% in 2023. So when we look at total Permian Basin rig counts, we can see Delaware, the Delaware publics, the Delaware privates, Midland public, Midland private, all decreasing. Half of that, about half of that activity was M&A, and the other half of that activity was capital discipline. In the beginning of the year, kind of in contradiction to WTI prices rising, we declined 24% in total on the basin, and you can see on the table at the bottom, Delaware public rig count dropped 17%, Delaware private rig count dropped 36%, Midland public dropped 10%, Midland private dropped 30%, and total Permian dropped 24%. So about 70 rigs dropped. So if we think back to 23, that 510,000 barrels a day was in the face of declining rig counts. And then when we think about 2024, we've got 630,000 barrels a day of growth with about 300 active rigs. We use roughly where that November 23 is what we're using as we look through to 24 in our rig count. So where that 600, or where do we expect that 630 million barrels a day increase to go? Well, about 49,000 barrels a day is going to head to Corpus Christi. And when we look at the graphic of the Permian to Corpus corridor, the flows and utilization, we can see, Cactus, Epic, Cactus 2, Gray Oak. You can see the capacity in red, and then the utilization, the dotted line. And long about middle of 23 is when we got above 85%, and now we're running right at 90% for all of 24. And that's just 90% to allow for walk-up rates, the 10% of walk-up volumes. So we run it at 90%. And of course, Corpus is the export destination of choice. So we did expect it to fill up in 23 as Permian grew. It did fill up. And winners, when we look at 24, there is the winners are really kind of all the pipes. Gray Oak takes the majority of 40 million barrels a day, and then Cactus 1 and 2 and Epic also do see volume gains. So our next, the biggest kind of winner in the Permian growth in 24 is Houston. And on that route, we see roughly 540,000 barrels a day of an increase. So when we look at this graph, I want to just draw your eye to the end of 23 going into 24. You can see the production growth, certainly, and the utilization increase. And also the capacity drops a little bit as Enterprise converted Midland to Echo 2 back to NGL service. That dropped capacity by about 210,000 barrels a day. And then by mid 24, utilization gets right at 90%. So we get just fully utilized, again, right below walk-up volumes. So the majority of that 630,000 barrels a day of Permian growth, again, moves to Houston, and roughly 540 million barrels a day of that 630.
Yeah, we're talking mostly about infrastructure. We're mostly talking about midstream pipelines, but it's also important to understand that, we're also talking about the winners on the producers, on the E&Ps that actually have this firm transport going to Houston. That is the incremental barrel that's going to be produced, wants to get on the water, can't go to Corpus, wants to go to Houston. So we're talking Oxy, Pioneer, Devon, Chevron, and Ovintiv that have the bulk of, the firm transport in that corridor. And that's really important as we go through this growth, that they have that ability to still move those barrels down to the water.
So winners here in on the Houston, aside from, there are definitely E&P winners, Wink to Webster, Permian Express, Midland to Echo, and BridgeTex all get quite a bit of increased volume. And then export dock winners, EPD's Houston Ship Channel Terminal and One Oak slash MMP, One Oak now, their Seabrook terminal. We'll see the kind of be the winner at the end of these pipes. So our last route is Cushing. So as we fill up or have filled Corpus, and as we fill up Houston, then we get to Cushing, kind of our other route out of the Permian, and we see about 17,000 barrels a day on this Cushing route. So made up of Basin, Centurion, Sunrise, with Corpus and Houston running at 90% by mid-24. This additional Permian growth will move on Cushing, or the other alternative, of course, is to pay walk-up rates on the route, say to Corpus, the kind of export dock of choice. Certainly spreads from Permian as we start to fill up Houston. There'd be some Permian price pressure, which in some increased potential rates as contracts roll off. And winner in the Cushing route, of course, is Plains.
Yeah, I just wanted to jump in. I think it's important to know where we're pulling all these volumes from is our crude hub model. So we'll aggregate Texas Railroad, any state, any FERC data, as well as going into Canada with the SUR data, and aggregate it into one dashboard where we can actually track these volumes on a monthly basis and look at these. That's how we bifurcate where these incremental barrels are actually going and what are the market drivers that are pulling them in which direction. So if there's anybody on the call that would like a little more information about how we track these volumes and how we've allocated them to the different routes, please reach out to Jim or Christy after the call.
So the other thing that we're watching, it's not a 2024 event, but it certainly would sort of shuffle the deck on how we look at the end of 24 and start to roll into 25 and then certainly 26. Two game changers are Enterprise Spot and Energy Transfer's BMOP export terminals. So we thought that we would hear Spot get announced on Enterprise's Q4 call. We were a little surprised we didn't hear it. BMOP has a takeaway commitment with Total, and look, when these things come in, if these both come in, they're game changers as they change the landscape, and they certainly change the economics on dock space, at Houston, and certainly is going to affect Corpus in that as well.
Yeah, and for EPD especially, it frees up a lot of their dock space, inside the harbor for their NGLs. So their NGLs are LPG exports. I think just to pause on that, it is a game changer, and it will change not just the crude markets, but also the NGL markets for the export.
So again, 3 reasons to not be bearish: Permian, and then next is TMX, and again, structurally going to change flows and price spreads in the U.S. We are pretty excited about TMX starting. Christy, I'm going to turn the mic over to Christy, and she's going to walk us through our expectations of TMX and the impacts.
So TMX is coming online at the end of this quarter. We're expecting line fill probably to start in March and see flows in late March, early April. When you talk about the Canadian WCS barrel, the Western Canadian Select Basin barrel, you've got to remember it's about 4.4 million barrels, primarily of a heavy sour quality, coming into U.S. markets. That Canadian barrel is just ubiquitous to U.S. crude oil markets. It hits every market, every hub, and it has an impact. So TMX coming online is huge. It is a game changer, and we will see some of the effects of it. It's great news for Canada. The chart I have up here is showing Canadian egress. The blue or the green line shows the egress, and it's pretty easy to see that the WCS barrel really hasn't had any. They did get a bit of a reprieve in 2022 when Enbridge had their Line 3 replacement, adding an additional 370,000 barrels online, but it was quickly, the Canadian production quickly ate that up. So TMX coming online at 590,000 barrels is huge. And keep in mind, it is Canada's only market for the WCS barrel without going through US markets, which again is incredible for Canada. We initially are forecasting TMX, we're going to see 470,000 barrels of flow redirected down TMX to their export dock at Westridge Marine Terminal in Vancouver. Those barrels are earmarked as export barrels. We have it earmarked at 470 because that is the committed volume on the pipeline right now. Once we get into first quarter of 25, we're thinking that that production is probably going to be more in line with about 525 a day. Now, where is that production going to come from? Initially, we think about 125,000 barrels a day will come from Canada. Now that they have some egress, those volumes, the Canadian production is going to grow. After that, we'll see some volumes reduced on Milk River, on Express, on Keystone. Not too much on Keystone. Most of that volume is pretty firmly committed. We'll see volumes reduced on rail, trucks going across the border, and then Enbridge mainline. Probably we'll see a reduction in the neighborhood of 150,000 barrels a day. But that's a short-term reduction. We see that primarily in 2024. By 2025, especially 2026, we see the growth of Canadian production refilling that reduction. So we are not anticipating this to be much of a displacement for PADD 2 refiners. Now, PADD 2 refiners will feel the effect. It's going to be competitive. They're going to need to step up to the plate. They're going to have to fight for their barrels. But we don't foresee supply in PADD 2 refiners really being displaced. Where we see the bigger impact is the Gulf Coast. The Canadian heavy sour barrel that makes it all the way to the Gulf Coast. So you're going to see reduced volumes on Flanagan, Spearhead, from Cushing on Seaway down to Houston Ship Channel or Houston Gulf Coast, and then on Capline from Patoka down to the Louisiana Gulf Coast, for a net reduction of in the neighborhood of 345,000 barrels a day. But we don't see that full 345,000 barrels a day really impacting the Gulf Coast refiners. Roughly 200,000 barrels a day of that heavy sour Canadian production makes its way all the way down to the Gulf Coast and is re-exported. We believe that those re-exported barrels will be redirected as Gulf Coast refinery supply. So the net impact that the Gulf Coast refiners will have to find alternative barrels for winds up being 145,000, or in the neighborhood of 145,000 barrels. The 145,000 barrels, they will need to find the replacement barrel. Just to note, that 145,000 barrels is not replaceable with the growth that we see in the Permian. That Permian barrel is a shale barrel. It's a light sweet barrel, and it will not replace a heavy sour refinery supply barrel. So where is that barrel going to come from? Initially, we think it's going to come off of the loop. Gulf of Mexico barrels are heavy sour barrels are being exported. Those will be redirected on the loop, and they will feed the Gulf Coast refiners. Additionally, we think that there's going to be some niche barrels throughout Texas and the Gulf Coast, meaning that people will start aggregating the sour barrels rather than blending them off and delivering them as refinery supply for Gulf Coast refiners. We also anticipating seeing an uptick in Venezuelan heavy sour imports, an uptick in the Mexican Mayan heavy sour imports. Now in 2025, we anticipate additional barrels coming from the Gulf of Mexico once the Mad Dog, Shenandoah, and Salamanca projects come online. And also we anticipate the growth from Canadian producers. Those barrels will make their way back down to the Gulf Coast and replace some of that redirected supply. But we don't feel like the change in flows, the barrels that the Gulf Coast refiners will have to find as the biggest impact from TMX. The biggest impact to TMX is going to be price, and that will hit every basin, most of the refiners. It's going to hit the hubs, and it's going to be the change in price of a WCS barrel, the Western Canadian Select price point for the WCSB Canadian barrel. So the graph that you see here, the blue background is showing you the WTS price. The red line is the WCS price. And keep in mind that is the Canadian barrel. So even if you take away, I don't know, $6.50 to $8 of additional transport, there's still a very healthy discount between that. The green line is the Mayan heavy sour. The blue line is the Mars, that's the Gulf of Mexico price point for the heavy sour. A couple of reasons for that heavy discount on that WCS barrel. It is a long way to go, all the way from Hardisty to Patoka to the Gulf Coast. And there's always bottlenecks somewhere along the way. Transporting a heavy, sour, very viscous barrel that far is tough. That's some of the discount. Some of the discount is there's been an abundance of supply. And then, it's just historical. That discount has always been there. The American refiners have really been able to enjoy a large piece of their supply at a discount. As TMX comes online, that discount will shrink. And it's going to shrink across the board for those heavy sours. So right now, when you look at the forward curve, for February and March, you're seeing minus 1275, minus 1380. Then when TMX comes online in April, you're seeing a minus 725. So already the forward curve is showing, it's about a 45% premium for those barrels just with the anticipation of TMX coming online. So again, this is going to be felt by the refiners on a good portion of their supply on basically 4.5 million barrels a day of refinery supply.
All right, thank you, Christy. And Nigel, I know I missed on Permian to Corpus. I missed a couple things.
Yeah, we're with the kind of premium route. I would say the cleaner barrel goes to Corpus predominantly because of the infrastructure that we have in place. That is where barrels naturally want to go first. And we also have some expansions. One that has been announced by Enbridge on Gray Oak. We also have an expansion that we know about with Epic. So there are some expansions that could come either short or shorter or long term that could debottleneck Corpus Christi. But as we're thinking through flows out of the Permian, as we sit right now, and at least for the next 12 to 24 months, that incremental barrel is going to go to Houston.
Thank you, Nigel. So demand is the price mover. OPEC Plus and China are driving with SPR backseat driving. So the SPR creates a bit of a floor as a backseat driver here. Stocks are lowest level in 50 years. And we've got this repurchase going on. So DOE sold 180 million barrels back in 22, and currently have a floor, or have committed to restocking at a floor of $79. So there's two RFPs out currently, one for April, one for May, for a U.S. produced sour barrel, both somewhere 79 or below. At current RFP levels, it'd take about 5 years to refill it. So what I found is I started to dive into this a bit with Christy and Nigel. It was hard for me to believe or get my head around that to buy back the 180 million, barrels that we sold in 22 at the current RFP levels of 3 million barrels a month would take 5 years. So it's almost unimaginable to me that somebody could own the SPR in this case, a 5-year call option with a movable strike price. Is like, that's a phenomenal floor and strategic sort of demand out there in the marketplace.
And we saw the impact, right? As soon as it dropped down to 73, SPR was starting to buy, and it kind of settled back up. So we've already seen the impact and how structural this buyback can be.
Yeah, God, it's just amazing. So I didn't, on world liquids fuel growth for 24, OPEC did come out again yesterday with updates. They stayed the same for 2024, and that's here in this graph on the left is OPEC, with China leading the way and India at number 5, with Mideast second to China. And we compare both OPEC and then EIA's forward liquid demand forecast. And the way we use them at East Daily, those are sort of our growth guardrails, somewhere in between. And obviously we're watching China and to see what happens as the year unfolds. And each time we update this, each quarter that we do this, we'll certainly see where are we trending, because of course this is as we said in the demand's the price driver here. This is certainly going to drive a lot of price, or a lot of price volatility. What I found, it's still growing. So liquids demand still growing, albeit at a much slower rate. When we talk about OPEC plus cuts, they're the driver in the seat.
OPEC cuts. OPEC lately has been nothing if not interesting. Definitely made for some interesting speculation and times. So when I talk about OPEC and some of the cuts that we saw in 2022 and 2023, I'm looking at it via OPEC numbers, and it's by looking at a global liquid supply and demand. So to start off with, the blue line is indicative of global liquids demand. The gold line is global supply of liquids. And then the red line is showing what global supply would look like without the OPEC cuts. So if we go back to 2022 in November, when OPEC cut just a little over 5 million barrels a day, 5.1 actually, they were very transparent about it. And they said they were intentionally shorting the market for price protection. They really wanted to see that $100 barrel, and they were willing to forego production to get it. Then as we ramped up into 2023, it was just a textbook example of buy the rumor, sell the news. There was so much speculation building up to what OPECs were going to look like, a lot of different interpretations on what does balanced global supply and demand look like, where is international growth, is it going to fall off a cliff? So the speculation was pretty large during that time. The market reacted, WTI went up, and then cuts were announced at 5.8 million barrels a day. That's, to put that in perspective, that's about 5.7% of global demand was cut. And it wasn't enough for the market. There was still a lot of skepticism. Would these cuts even really happen in the voluntary nature? More speculation about what is international demand, which just added more volatility in the market. At East Daily, we, in addition to looking at these numbers, we're also looking at it in terms of the demand, the strength of the demand pull for the US barrel into international markets. And we do that by looking at the spread between Brent and TI. The wider the spread, the greater the pull. So as you saw in 2022, a little bit of a boomerang there. It went down to very slight negatives and then boomeranged back up to about $10. That $10 is an extremely strong pull for that barrel. Today, we're seeing that spread, kind of in between 5 and 6 a little bit, which is a strong demand pull for that export barrel. So that's telling you that the international market, they need that barrel, they want that barrel. And so some of these contrarian views on what the market's doing, what supply and demand look like, ultimately are going to just result in market volatility.
So 3 reasons not to be bearish in 24. Again, Permian to Corpus filled in 23. We expect Permian to Houston to fill in 24. TMX will structurally change flows and price spreads in the US and demand's the real price mover here with OPEC and China driving and SPR backseat driving. So our current crude oil product suite, we have a weekly in a crude oil edge that goes out, and we have a monthly in a crude hub model, which is an Excel file. Starting in Q2 or mid Q2, we're going to add some monthly products so that you guys can follow the market in a way, the same way that we're going to follow the market. So the crude oil edge monthly, just supply and demand for major basins. I don't know any other way than to have at least a monthly benchmark of how I did for the month before. So in the Bakken, how did I do on supply? Was I right? Was I wrong? How did I do on demand? What happened? What changed in price spreads? So all of that we're going to put in our monthly crude oil edge. And then we're going to supply production forecast by basin and hubs, and then active rigs by basin and producer volume by basin. Again, all things to, as Nigel said earlier, in what our clients, trust that we do and help them do, is to put all this data together and put it in a way that our clients can use it efficiently to make just more confident decisions.
So we often get asked by customers or attendees of our presentations, how do they work with us? So Jim went through the data provision side where we provide basin level reports. We also provide commodity specific reports as well as midstream company financial reports. We also, a large part of our business is advisory or the consulting services, where these are more specific bespoke projects that are really scoped out based on customer needs. There's a couple of examples at the bottom where we've been involved in, financial and also fundamental due diligence on assets, very, very specific market studies, either on refined products, LNG demand, and crude oil markets, and also through midstream, debt investments on even private assets. So if there's any, we have a QR code in the bottom right-hand corner. We'll also be sharing the slide deck after this webinar. So if you have any questions or would like to talk to the consulting group further, or would like a free trial of any of our data packages, please reach out to us because we'd be happy to set you up.
Great. So thank you all very much. There's a couple QR codes on our last slide here for our crude oil newsletter. That's our weekly Crude Oil Edge. And then also do an individual, more specific, tailored crude market update. And if you have any questions at all, please do not hesitate to email either myself or Christy. Thank you guys very much. Enjoy your day.